Welcome back to the Home Path Podcast. This is Raphael, and today I'm going to talk about what lenders are really looking for, how to unlock your mortgage approval. Remember, you're going to first get a pre-qualification once you're in underwriting, and they get all your documents that they need. They'll give you the final blessing, which is a approval with conditions, and conditions are normal. It's just that you need an updated bank statement or pay stub or whatever they need, all the way to the end where you get your final blessing, which is your what's called clear to close, or what we abbreviate as CTC. And then that means that you can now sign your loan documents and finally close. So what we normally look for, or what some of the lenders, which I'm a mortgage broker, but the lenders are the ones who are actually funding the money, is that at the end of the day, is just what's called your ability to repay. That's it. They just want to look at all the factors to determine your ability to repay that loan, because that's all they care about. Can you pay what you're going to borrow? And there's a lot of mathematical equations and factors that equate for this decision. For loans that are backed by Fannie Mae or Freddie Mac, a lot of them will have some standards that are automated. So when we put everything into the system, we click a button and then it'll tell us that if it's approved or not, or at least give us some sort of blessing right off the start, which sometimes we refer to as a DU approval or desktop underwriting approval. And it just means that a computer looked at it and conditionally gave it its blessing based on the information that we put in. Now, just because we put on there that you worked at a certain period of time at a job, and then we find out that you weren't there for that long, then yes, that quote unquote approval is not valid, because based on the information we put into the system, it told us that you were approved, but we still have to go through a verification to make sure that you're actually approved. So what we look for is usually the rule of two, which is 2 years of employment history, 2 years of your renting history. Where have you lived? Usually that's we want to see 2 years, 2 years of taxes, and 2 months of bank statements to make sure that any money that you're using is seasoned. And that's very helpful to know that your money has been sitting there, that you didn't borrow the money, that it wasn't just cash under the mattress and then just stuffed into the bank account, because what they consider season is after 2 months. So remember, you need to have your money saved up and already showing two consecutive bank statements with the money already marinated into your account, so they don't ask where it came from or anything like that. And once it's been sitting there for 2 years, it's considered season. And then you need your last 2 years of taxes and your last 2 years, your last 2 months of pay stubs. Now, if you're doing a bank statement loan for those that are self-employed, you don't need taxes, but you do need the last 12 months of business bank statements to get pre-qualified. So it's kind of cool. So if you're listening to this and you are a business owner and you don't report a lot on your taxes because you claim every deduction under the sun, a lot of times, a lot of people, will say, hey, I own this business, I make $1 million a year. And then we look at the taxes and it only shows they make $93,000 because they claim so many deductions that when the bank looks at it and say they don't make $1 million, they make $93,000 a year. So a lot of people get that confused. And for that reason, there is an alternative in saying, well, let's take a look at what was the average deposit that how much money did you deposit on average every single month? And based on that, we can get you pre-qualified for a business bank statement loan. But what we really look for is your ability to repay. And a lot of times, if you don't have perfect credit, which whether you're a brand new homeowner, if you have less than perfect credit, don't shy away. There's a lot of different ways to either boost your credit or get a home loan with less than perfect credit. So some of the things that we look for when some of the things don't look that great is called compensating factors. So what is a compensating factor? A compensating factor is saying, hey, we have a really low credit score, but they're putting down 5%, 10%, 20% down. So a lot of times the bank will kind of not overlook it, but they'll say, you know what, this is a compensating factors. They've had some blemishes in the past for whatever reason, and they have stability. So maybe they've been at their job for 3 years, 5 years, and a lot of these factors are called, what is these factors that are compelling factors that are going to help you kind of offset some of the blemishes that you've had. So a lot of times it's always good to consult with us, to talk with us, because everybody has a different situation or scenario. And depending on what that scenario may be, we may have a lender with a guideline somewhere that can get you pre-qualified to get you to purchase. It just all depends on the scenario. The one thing I can always tell you is money solves a lot of these problems. So a lot of time, for example, if you have a down payment that, let's say, of 5% or 10%, but a lot of times when we look at these, let's call it 10%. How much money do you have in reserves? So meaning if you lost your job, the day after you got your keys, how long can you last before you start defaulting on your mortgage? So if you have 3 months reserves, 6 months reserves, a year reserves for your mortgage payment, they always look at that and say, oh, that looks really good because God forbid something happened. He has some reserves. So he or she is ready. If anything happened, we know and we feel secure that they can still meet their obligations over the next 3 months, the next 6 months. And that's very helpful. So again, that's called compensating factors. It's saying, hey, we have a lower credit score, but we have 6 months of reserves, meaning if anything happened to this individual with their income, they have 6 months to keep paying their mortgage while they figure out how to get another job. So those are, again, they're called compensating factors, and we're really looking for your ability to repay. So when we look at everything, it's, how long have you been at your job? How much money do you have saved up? How high is your credit score? And if one is off or the other, if you go to your traditional bank, they're going to say, you know what, go kick rocks. They're not going to want to touch it with the 10-foot pole. And that's okay, because there's so many other options for you that you just don't know that exist. And that's why there's mortgage brokers or wholesale mortgage brokers out there. The whole broker community has access to these lenders, because we know that everybody has a different situation and they're not going to fit into a cookie cutter program that every bank wants everybody to fit in. Of course, they want to take the less risk. The reason why they're not taking these type of loans is because they don't want what's called riskier loans, or people who may not be able to have the ability to repay. And they're always looking out for the bottom line, the dollar, and saying, we only want loans that show the ability to repay based on these guidelines. So the sooner you understand that, the sooner you'll know that based on whatever situation you have, you may need to find a different route to buy your first or second home. And there's so many programs out there. The best thing you can do is just book a time with us, or message us, tell us your scenario, and see if there's a solution for you. There's not always a solution, but I can tell you that the two things that will help you is if you can already start boosting your credit score, or if you start saving money, season it, because a lot of times, a lot of people do have money, but it's mattress money. It's under their mattress, and for whatever reason, they're scared to put it in the bank. And that's not going to help you when it comes time to actually make some moves, because now you got to wait time to season it, or you have to sometimes, depending on the program, find a family member, or brother, a sister, a dad, or a mom to give you the money as a gift in order to offset that. So a lot of times, what lenders look for is your ability to repay, and if you can't show that, then we have to look for compensating factors. So think of compensating factors as like, what other positive things can you show that you've been paying on time ever since you defaulted on a credit card. Some of you have gone through bankruptcy, and making sure that there's no late payments on any obligation on your credit report after that bankruptcy. There's a lot of different factors to look at, but you want to make sure that you're showing your ability to repay, and you have solid compensating factors, And if you don't know what those are, definitely connect with us to help you out. And that's all I got for you today. And I will see you on the next episode.